Hey, what's up, guys? Node Investor here. I want to do a little bit of a different video today. I'm going to be talking about the death cross. Everyone is kind of overblowing this out of proportion a little bit, making a big deal, and I just want to go over what it is and what I think about it and why I really don't care. So let's get to it. The death cross for Bitcoin is coming. And so I'm going to cover three main things. What is a death cross? Go over some examples. Talk about its inverse, the golden cross. Some of the three most popular moving averages that are used. Why I believe it's inferior. The 50-day, 200-day doesn't really matter for crypto, and I will explain why. Crypto versus stocks. And ultimately why I really don't care, why it's not going to really influence my trading and investing in any significant way. I'll cover some ways that I do use moving averages and how to use them to see how far prices are and some of the trading systems that you can develop using moving averages. So let's get to it. What is a death cross? For those that are not familiar, you've heard this term. It sounds kind of scary. You're wondering, what the heck is this death cross that everyone's talking about all of a sudden? And so, very simply, it's a crossover with two moving averages where the shorter one crosses below a longer term moving average. That's really it. And so let's say you have one moving average. Let's say this represents the 50-day moving average. And then you have a longer term moving average, the 200-day moving average. When that 50-day moving average crosses below the longer term 200-day moving average, that is what they refer to as the death cross. And what it signifies is this longer term shift in the trend where now we're going to indicate a bear market is on the horizon, or it validates this longer term downtrend. And that's why it tends to be made such a big deal. Now, the inverse is what they call the golden cross. And that's basically when the shorter term moving average goes back above the longer term moving average, and it kind of indicates, hey, we're in this longer term bull mode now and things are going to head higher. So let's take a look at the charts. So we're seeing articles like this, and as it relates specifically for Bitcoin, right, the risk of the death cross is still there, and we're talking about how basically this longer term moving average, the 200-day, is going to move below the 50-day, and they're not the only ones publicly publishing this type of article. I've seen it in several news outlets. I've seen a lot of YouTubers starting to talk about the death cross, and it kind of gives the impression that it's really a big deal. And so let's look at the charts here. Looking at Bitcoin, this is the daily chart of Bitcoin on the Bitstamp exchange. And I'm going to overlay the two most popular moving averages that are often referred to when they're talking about the death cross. And that is the 50-day moving average and the 200-day moving average. So on this chart, the 50-day is this bright blue line, and the 200-day is this red line. And you can see here from the charts that the two lines are getting very close, and it looks like an intersection of these two lines is imminent, whereas the 50-day is going to cross below this 200-day. So what's the big deal, right? Does that mean that suddenly there's going to be a sell-off? And usually that's the concern. It's, hey, when this thing crosses, we're going to see a big volume sell-off, because then people are going to really become bearish, and that means the market's going into a longer-term bear correction. And so let's look at some past history to see if that really holds true. And so let's take the most recent years in the terms of the big correction, and often referred to, the 2014-2015 correction is the most referred to correction here. So the last time we saw a major bear market in the crypto space, and Bitcoin specifically, was after the big peak around $1,100 in late 2013, and going into 2015 we saw a long pulled back that really was the last big bear market that this space has seen. And so you can see here the death cross happened right here on, what day is that? Let me move my indicators here. So that happened on April 9th of 2014. And so that was the first intersection of these two moving averages on the last big bear. But there's something to note here. We had already pulled back from that point, 60-70% by the time these two crossed. And interestingly, after they crossed, literally the day after the market started to rally, we went up about 50%. We pulled back and it peaked up around 90%. And that was immediately following that death cross. And then the moving average caught up again, the 50-day. We had a golden cross in July of 2014. And quickly after that, we saw a pretty big correction, and that ultimately culminated in the low of the big bear market in early 2015. And so there was really nothing to do with this information. We had already been in a pullback. You didn't need two moving averages crossing to tell you that the market was in a corrective mode. If you're waiting for that to happen, you're very late. And this is not a very reliable indicator from that sense, because it lags significantly just due to the nature that the 200 days is a very slow moving average that just kind of takes a long period into consideration. And so factor that in, the fact that these death crosses haven't really initially had that material impact, right? I mean, it doesn't tell you anything new that you didn't already know. Now, the other thing to look at is the 200-day moving average really applicable in terms of the crypto space. And so this moving average pair is very popular in the stock market world, and it represents basically 40 weeks. So the 200-day, you got to remember, the stock market world is a 5-day trading week. And so that is a 40-week moving average, and the 50-day is a 10-week moving average, and it's a little bit more longer term time frame. And when I do my stock analysis and stock trading, very often I do look at weekly charts because it's a little bit slower moving. In the crypto space, it's very volatile, much faster moving, and you guys that have already been watching my channel for a long time know that most of the time on my charts I have very short-term moving averages, the 10 EMA Exponential and the 26, and sometimes I'll do a little bit longer, but generally you're shorter term, and those tend to be the most helpful when making trading and investing decisions for me. So I would argue we need shorter term moving averages, and that this 50-day and this 200-day really is not that strong of a moving average to be using in the crypto space. And so let me examine why I believe that. So if we go back to this most recent bull run, you can see here clearly prices are above the 200-day moving average. But when the prices pull back, in the stock world, generally these moving averages are looked upon as a place of support, a place where the price will bounce into and find support near term. And you can see here we had several big pullbacks in the last big run, but they very rarely came too close to that 200-day moving average. This one did touch the 50-day here, but most of the time they were somewhere above. And if you look here, this most recent pullback in February, we did undercut the 200-day, and we rallied right into that 50-day, but then we undercut again, and now we're approaching this death cross scenario. And so I would recommend using shorter term moving averages, and the way I look at it is I adjust the moving averages for that 5-day trading week into the 24/7 market that we are in with crypto. So the moving averages have to change by some ratio to adjust for that. And so the way I do it is I will use a shorter term time frame. I will use, instead of the 50-day and the 200-day, I will use a 36 and a 140 because it normalizes the duration a little bit. So using that new moving average, you can see here during this last pullback that the 140 served as a little bit more of a representative of a longer term trend where that moving average was touched and was used a lot closer. The shorter term moving average also was kind of the 50-day equivalent in the stock. And using that scenario, we had our death cross in middle February. We've already experienced that with these shorter term moving averages. But again, you didn't need the death cross to tell you that the market was already in a corrective and a bearish mode. So let me show you how I came up with these two moving averages. So adjusting the moving averages very quickly, and I won't go into depth of this just because it's kind of boring and just kind of some quick calculations here, but just to show you how I adjusted them a little bit here. In the 200-day stock trading day is actually 280 calendar days because you got to factor in weekends and holidays. So 280 days is just a straight calculation. It's actually a little bit higher once you factor in some of the holidays and partial trading days. So it's more like 288 to to 290 or something. So the way you get that is 200 days divided by 5 days a week, 5 trading days equals 40 weeks. And if you take the 40 weeks and normalize it for 7-day weeks, that gets you the 280 days. So you take that ratio, 200 over the 280, multiply it into the 200-day moving average, and that gives you the 140-day moving average. If you use the higher number on the actual calendar days, which is closer to 288 or 290, then your adjusted moving average will drop a little bit to 136 to 138 or something, but it's still pretty close. The 50-day, you use the same calculation, and that equals around 71 calendar days. That's 10 weeks. Multiply that out, 70 days. Use the ratio, and that gives you your 36-day moving average. And so that's how I got to that. Let's go back to the charts to show you how I did that. So here's the daily chart of the S&P 500 index, and this is approximately 1 year's duration. And so I just wanted to show you real quick with the date tool here in TradingView. If you started this on the first trading day of 2017, which was January 3rd, and you took that out 200 trading days or 200 bars, you can see here when we get to 200 that equals 288 days. And so that's the difference. So 200-day moving average is actually 288 days on the calendar in terms of this duration, and that'll fluctuate a little bit due to holidays and such. So you can see it changes 287. When you move out here, it goes to 292. And so depending on the span of time and how many holidays and such were in there, that will change the calendar day a little bit. But you can see that it's not 200 days. It's much more than that because of the time in between. So you switch that over to the crypto space and looking at Bitcoin. If you go from March 1st, you can see 200 days is a much shorter time span, and it's 200 calendar days because of the 24/7 markets. And so you can see that this doesn't go quite as far. In the stock market, the 200-day took you into the October time frame, and this one here, if you went from January forward, it would only take you out to April, May or something. What does that come out to? So going from the 1st, it takes you out to June. So July. So the calendar days is certainly equals the 200-day moving average here because of that. So I just wanted to kind of illustrate that the difference there is that you have to consider because of the time frames in which these markets trade. So let's say we still use the 200-day. What importance does it have? Why does it matter, and should we use it for any kind of trading and any kind of reference points? And so the way I use moving averages is because they represent a mean. They represent an average. That's what they are. And in trading and investing, very often there is a reversion to the mean. And when you have something that just moves very far away from a key moving average, then it will very often either need to pause and let that moving average catch up, or it will need to come back in to meet the moving average. And so you can see here during the last big run we had, you can see this 200-day was relatively close to the price, relatively close, but then the price really started to accelerate. And as it went higher and higher and higher, it was very far away from the moving average. At the peak, the 200-day moving average was over 70% below the price point. Take that to comparison to March, where the 200-day moving average was about 30 some percent below, and near these dips it was only 20% or so. And so Trace Mayer, who is a very big proponent of Bitcoin and a big investor, a very smart person who I would not argue with or anything, he does rely on the 200-day moving average, but not from a trading perspective as much as using it as a guide, similarly to what I just showed you. How far is the price from the 200-day moving average? And you can see here he has a little table where he talks about relative price, and when it gets too far it's a little bit overvalued, and when it gets smaller or under, it's a good bargain, right? So undervalued, fairly valued, overvalued. And so he's using it as a gauge, and you can use different moving averages depending on your time frame. If you're doing shorter term trading or longer term investing, you can still use them as a gauge. How far away are we from this longer term average? And what tends to happen is there is a reversion to the mean one way or the other. Either the price has to pause for a little bit and let the moving average catch up, or price has to come down quite a bit and let the moving average catch up, and you create this longer term cycle. So how do I use moving averages? Now, first off, if you've taken my course or if you've studied anything I teach on the technical analysis side, I always say price and volume is always first. And any indicator, whether it's a moving average or an RSI reading, any indicator is always secondary, and is there really only to confirm what you believe you're seeing in the price action. So, but they do help. Trend lines help. They show you points of support and resistance, and I use moving averages for two things. I use them, one, to kind of signify some near-term price trend changes, as well as potential places of resistance and support. And so the two moving averages that I like to use are exponential moving averages. I use the 10 EMA very frequently. You've seen in my videos. You could also use a 12, or you could use a 26 for a little bit of a longer term view. And so those are the two I use. And really, they're very short term, and on the daily basis, they'll just kind of give you this early indication of a potential trend change. You can see here during the big run up, the moving average held very nicely. It would pull back, pause right to the moving average. It would rally, pull back to the moving average, pull back to the moving average. And that was just a place of support where the price was defended and it would not close below that. And then once we started to close and break below it, it tended to be a little bit of a wall. We would rally above it briefly, undercut it. And so here in the going to current prices, we've seen this big pullback. We saw that the 10 EMA was a wall on the bounce there, and we're finally above it, and here we are pulling in a little bit. And the same works on the shorter term time frames. Here I am on the 4 hour. You can see that this has been a place of support so far, and on the 1 hour for trading and such, it broke down from the moving average with very big volume, and it's rallying on lighter and lighter volume, and it rallied right up to that moving average, and here it is starting to pull back again on increasing volume. And so you use it as a tool. It's never a standalone indicator in terms of, oh, it's above or below, sell it or buy it, but you use it as a tool, as a guide to say, hey, this is probably where we might pause, and you use it to validate other areas. This 10 EMA also happens to be a place of resistance here on the chart, and so it just kind of starts to validate, yeah, that's where I'm thinking that the price will pause, and here we are pulling back pretty quickly following the bounce into that moving average. And so that's how I use it in a very simple way, and I use it to confirm what I'm seeing or what I'm looking to see. Now you can use a moving average crossover method to create a pretty good trading system. And the way it works is either a double crossover or a triple crossover method, but you got to use much shorter moving average time frames. And so let me go back to this other chart and show you an example of that. And so when you're using a triple crossover method, you're using 3 moving averages, and they're typically shorter term time frame with a more intermediate longer term. And so the most common is the 5, 10, and the 20. I've also seen something a little bit shorter where you can use the 4, 9, 18, and that's because some of those ratios that are in there. I won't go into too much of that, but if you go with the 5, 10, 20, the way the crossover method works, let me clear these here and put the lines on the chart here for you guys. And so what I'm doing is I'm going to put a 5, a 10, and a 20 on the chart here. And let me show that here. Let me change the colors here real quick just to help see this a little bit better. Okay, so that's a little bit easier to see, but still not too hard, not too easy to see just because of all the different colors on the charts here. But a couple of things to look at here. Let me zoom in here in the most recent time frame. So the bright blue line at the bottom is the very short-term 5-period moving average. The green one is the 10-period, and this red one is the 20. So just using a very simple triple moving average pairs here, you can see 5, 10, and 20. And the way the crossover method works is when you get a crossover of the very shortest one, so in this case the blue line, the 5, crossing below both the 10 and the 20, then that is the sell signal, and vice versa. So it has to cross both. Now when the middle one crosses the longer term, then that just confirms the sell, but that usually lags a little bit. And on the flip side, the buy on the crossover method works the same way. So when the shortest moving average crosses both, then that would be your buy signal there. But you can see that it's still very much a lagging system. And when the prices go sideways and are a little choppy, then you can get a lot of crossovers back and forth until things settle out. We saw that most recently last week when prices were going sideways here for a few days, and the moving averages were kind of just all over the place, getting very narrow, very choppy. And so it's certainly a system that you can use when the market is trending, when it's identifying longer term trends. You can see here this crossover was very early there on that 4-hour, and it pretty much held, and it gave you a sell signal up here near the highs. And so you would have been able to capitalize on this leg up, and would have kept you out of this entire leg down, but then it got you in back here for a few hours, and then it got you right back out, and it didn't get you right back in until here a few days ago. And so it's not a bad system, and it's been used for a long time by different traders. And so it's just a tool, and you got to use it in conjunction with patterns on the charts, with support and resistance, with trend lines, and it's just another way of validating potentially what you're seeing on the price volume action. If you think you're seeing a reversal, maybe the moving averages will confirm, the volume will help you confirm that. If you think you're seeing a type of pattern, then the moving averages will also give you some of that further information. So that's all I wanted to share, guys. I know the death cross sounds scary. The price may fall a little bit in sympathy with some of that, but remember, this is a longer term moving average, and in terms of the 200-day and the 100-day or the 50-day, we don't need those two moving averages to cross to tell us that the crypto market space has been in a little bit of a bear market here for the last 3 months, and the alts are already down 60-70%. Now we're seeing some good bounces off the lows, but Bitcoin is down significantly since then. And so it's very much a lagging indicator, and vice versa. When they finally turn positive and we get the golden cross, prices will already have moved significantly higher by the time that happens. So just wanted to point that out, guys. Wanted to kind of share some information. I know this is a little bit different, a little bit longer of a video than usual, but I hope that helps, and I hope you guys can kind of use this information to help with your decision making. Thanks for watching. Until next time, take care, everyone.